Hi, I'm Manu Walia from Continuum Global Asset Management. It's May 27th, and I'd like to bring in our market commentary as we see the markets in the short and the long term. Before I go ahead and talk about our views on the markets, I'd like to make a quick, brief background on what's been happening over the last 12 to 18 months in our view. The overall turmoil in the market started out in '08 with the U.S. housing market going through a pretty tough time. And we all know why that happened. Too much leverage, people going with adjustable rates, with interest-only rates, which got them into trouble. What led to, at that point in time, was a financial crisis in the U.S., which flowed into other countries, Europe, some Southeast Asian countries, Latin America, and so on and so forth. Once we negotiated through that tumultuous time, there was a recovery and everybody became very giddy. Markets started to move back up, and we've seen one of the hottest streak in the markets over the last 12 to 14 months. That was really based on two things: that the US slash global economy would recover, there's earnings growth, and revenue top line growth. So people started talking about how long can we sustain this? How long would the global recovery continue? So right before the European crisis started, people were concentrating on earnings and unemployment. Well, I think that we have made a turn. I think that we are in a phase where we see the US and the global economy recovering. Manufacturing is recovering, services is recovering. There is no wage inflation. So there's a lot of positive factors that are working in favor of markets moving forward. And I'm not talking about just capital markets, I'm talking about Main Street. Having said that, I see that the rhetorics and the media has brought about a lot of news that may not have been so important to the markets, which is becoming more and more important, and people are reacting. For instance, as I said, today is May 27th, and while I talk, the markets currently are up about 2%. When I talk about markets, I'm specifically talking about the US broad-based indices like the Dow Jones Industrial or the S&P 500 index. Well, why is the market up today about 2%? And the reason is that China came out and said that we are not considering the euro currency, as something of less value, or of diminished value. We still believe in the euro, and we believe that a basket of currencies, the US dollar, European, the euro, the European currencies, and so on and so forth, will still be a viable currency for us. Now, having said that, the impact on the market is that the market goes up 2%, and if you took the global markets, that's about $500 billion. So let me put this in perspective. If you look at the entire population of the world, we have about 6.2 billion people. US and Euro population is less than 10% of the world, but their economies comprise of close to half, or a little bit more than half, of the world economy. So when you have a rhetoric like that China, which is a behemoth, a big country when it comes to GDP, or the growth in the GDP and so on and so forth, that rhetoric makes a huge impact. In other words, it can move the world market value by almost $600 billion. On the flip side, if you look at the India slash Chinese GDP, it's only about 12 to 15% of the world. But what it tells you is that the rhetoric coming from the emerging markets is becoming more and more important. Yes, we cannot ignore a 15 or a 14 trillion dollar economy, which is the US, and another 12 to 13 trillion dollar economy that is euro. But it is apparent and it's very clear to me, this is my opinion, that the scope of growth in the US slash euro is lessening as opposed to the scope of growth in China, in India, in Brazil, in Russia, some of the emerging areas. And the reason is because the population of these places is a lot higher, and the scope of growth in their disposable income just by a small increment in the growth of their consumption will be very, very high. So, what I'm trying to say to my clients is know yourself. If you're a short term investor, and when I say short term, I'm not talking about day trading, I'm talking about a couple of quarters, 3 quarters time horizon, one can truly benefit from trading this market. But if you don't have the stomach and you don't want to watch the ticker on a daily, weekly, or monthly basis, then you would want to be invested in the longer term trend. And by that I mean is definitely have exposure to the emerging countries like India, like China, like Brazil, and wait for the times when you can feel comfortable buying, uh, bigger banks in these areas, which are hurting right now, or bigger manufacturing units that may be hurting with the market. But in the longer term, the probability of making huge returns is in those areas. Again, coming back to the shorter term, if you can make a decent return, again, that depends and is relative to an investor because everybody's unique. And you look at how well or how much conviction do you have for each trade. Once you do that, um, it becomes a lot more palatable for each investor to take it because you are reminded of your time horizon and your conviction in that particular trade. Now, this may sound a little more vague to the viewer, but if you'd like to talk about specifics, please feel free to give us a call at Continuum Global Asset Management. You can find all that information on our website, which is www.cgamadvisor.com. Thanks for listening and happy trading.